Okay, now let's take a look at LIFO. If you'll notice, our beginning inventory, January 1st, is calculated exactly the same as the way we did it with FIFO. We're taking our units, 100 units at $20 a unit for $2,000. Our first purchase, July 8th, we purchased 320 units at $24 a unit for a total of $7,680. So if you look at our balance in units and costs, we have our beginning balance, the 100 times 20, and our purchases, the 320 items we purchased at $24 an item. And if you add these two items together, you'll get $9,680. So at this point, it's exactly as it was in FIFO. Here's where the difference comes in once we make a sale. So on November 1st, we sold 400 items. Now with FIFO, remember the first items we purchase are the first items we consider we sold. However, with LIFO, it's different. It's the last item we purchase that we consider to be the first item sold. So in this case, our last purchase was this 320 items at $24 an item. And the other 80 items to make up our 400 is going to come from our beginning inventory. So it's going to be 80 items at our beginning inventory price, which was 20. And if you add those two totals together, it will give you $9,280. So our cost of goods sold is $9,280. At this point, our remaining inventory is 20 units at $20 per unit. It is $400. The next thing we're doing on November 16th, we're buying some more. Purchase some more inventory. So we have 180 items we bought at $26 a unit for a total of $46.80. So now let's look at our ending inventory. We have our 20 items at $20 an item, and we also have our 180 items at $26 an item. So the total we have in our ending inventory, if you add these two together, the 400 plus the $46.80, $5,080. So our ending inventory is $5,080. Our cost of goods sold is $9,280. Last item we're going to look at for perpetual inventory is our average cost method, which is called moving average method. Again, beginning inventory was the same. We had 100 units at $28 a unit for $2,000, just as the same as it was before. And our purchases so far, when we purchased the item, the 320 items at $24 an item, we're going to show in purchases $7,680. Now we're going to sell something, but before we do that, we want to look at our balance in units and costs. So the way we're going to determine this is we need to look at our total inventory amount. Well, we have $7,680 and $2,000. So our total amount of inventory is $9,680. We now need to divide that total amount at $9,680 items, $80, by the number of units we have. Well, right now we have 320 plus 100. We have 420 units. That makes our unit price approximately, we're rounding, but approximately $23.05 per unit. So the way we're going to record it in our balance in units and costs, we're going to have 420 units at $23.05 per unit for our total of that $9,680. Okay, next we finally have a sale. We've sold 400 units. As I said, our sale was November 1st. We've sold 400 units. So at this point, we want to look at our cost of goods sold for those 400 units. We have sold 400 units at $23.05 a unit. If you multiply that out, that will equal now $9,220. That's our cost of goods sold, $9,220. Our remaining units, we have 20 units at a price of $23.05 a unit for a total of $461. On November 16th, we purchased some more units. We purchased 180 units at $26 a unit for a total $4,680. Now what we have to do is we have to again determine our average cost. So in this case, our total inventory between the 4,680 plus the 461 that we previously had, the total of those two numbers is going to be 5,141. Now we need to divide that by the number of units we have. We bought 180, we had 20 in our inventory, so our total units are 200. So now our price per unit has changed. The price per unit is now $25.71 per unit. So our ending inventory is going to show 200 units at $25.71 per unit for a total of $51.41. So our ending inventory is $51.41, cost of goods sold $92.20. The value of inventory is lower than its cost. Companies, it's a departure from the historical cost concept, but companies can write down their inventory during the period that it actually occurred in. And this coincides with the conservatism concept in accounting, where if faced with a choice, you want to, by all means, take the choice that will not overstate your assets or overstate your income. It's a lot more fun than the perpetual inventory method. So, the first case, we have cost of 10, market of 12. So, our cost is lower. We will take 10. Second case, item B, we have 4 different inventory items. Cost is 16, market is 14. We're going to take the market at 14. C, cost is 8, market is 11. We're going to take the 8. And our last case, cost is 6, market is 5. We're going to take the 5. So we would add these items together, 14, 24, 32. And this would be our inventory value. When we're doing this is the cost that you would go out and be able to purchase your inventory for, not what you would be selling your inventory for. So that's what we're talking about when we talk about this. But that's all there is to it. That's how lower cost or market works.